the second question. You know, you've sort of alluded to it already, Anthony, and so you need to kind of help me here if you think you've covered it or whatever. But you've kind of spoken a bit to, you know, the equities market, the bond market, and the property market. Is there anything else in terms of markets, and maybe now this would also involve kind of countries, you know, so, you know, the difference between the US and Europe and stuff in terms of different markets that you would be looking at?
I think this is a great time to pick up, bring up courtesy of JP Morgan, the asset allocation returns in that.
Gotcha. Yeah. I'll get it. No, I got it for you here. This one.
Yeah, that one. Yeah. So I'm not sure whether people are going. Okay, they should be able to see it. So Anthony's going to talk to this, and this will talk to countries and everything. Now, bear in mind, it would have been wonderful to do this on the 1st of January because we actually would have looked like geniuses in January, because our predictions in January that we made around what to position in that were made off, and we've always been very. This doesn't change, guys. Asset allocation, and this is not all of the asset classes we work with, but asset allocation is going to account for 85% of your return and is the fundamental building blocks of asset management and a financial plan that's going to, you know, produce income or anything. But Anthony's going to talk to this, and this will give you very specific kind of views around the returns, the averages, and where we think the value lies.
Sure. All right. So what is this? I mean, this is quite a busy chart here. But really what this is saying, and it's taking you back to 2008 on the far left and ending on 2022 on the far right. And basically this is looking at the major asset classes, and it's basically showing the return for that year. Now, this is something that we pay close attention to. Don't get me wrong. We don't solely base our decisions on this heat map, but it gives us a good starting point in what to look at. So you'll notice everything has a color, and it's quite easy just with your eye to kind of follow where and how each asset class has performed over time. So you'll notice pretty much off the bat that there's quite an obvious trend in the sense that these colors kind of move to the top and then they kind of trickle their way back down. So really that's what we're looking for. We're looking for that trend. So I mean, if I can take 2018 here as an example, it's a color that stands out to me as this light blue, the REITs, which is real estate investment trust, which is essentially your property plays. And you'll see that goes from where the cursor is now, it trickles all the way to the top. And then it's in 2022, it's literally the worst performer. Now, you can do this with any one of the colors, but you'll notice, I mean, it's not a perfect science here, but you'll notice this kind of trend where it trickles to the top and then it trickles its way back down. And really, that's just the different cycles of the different asset classes playing out. Now, when in terms of asset allocation and your mix to these different baskets, you're obviously going to be wanting to favor what you think is going to do well, and what you think is going to recover, and you want to downweight things that you don't think are going to do so well. So really, that's where the initial decision making starts for us. So if you look at 2022, like I said, you'll see REITs here on the back foot, small caps on the back foot, and emerging market equity on the back foot. Both of those have in the past enjoyed kind of top quartile performance, and they've kind of trickled their way down. So that immediately at the end of last year, beginning of this year, starts to get us thinking, and we start to dive deeper into each one of those asset classes. Now, I'm going to ask Scott to just jump to the one that looks identical to this, but it is slightly different. This one, and you'll notice here, whilst some of these names are slightly different, but you'll notice here, this one includes on the far right column, it includes January 2023. Now, as Garth said, in hindsight, this looks like we're cherry picking, but we do this exercise at the beginning of the year, and it's quite rewarding to see some of those lower players starting to push their way up to the top. You'll see the emerging markets growth, REITs, small cap. We touched on them just now at the end of 2022. They were at the bottom. Now they're pretty much at the top. So these are interesting things that you start to pick up over time, and it gives you guidance as to which sectors you should be, or which asset classes you should be paying more attention to. So really that's how we start to kind of screen, and we start to look at these different asset classes, and then obviously we dive a bit deeper into them. And again, going back to what the client is trying to achieve and what the financial planning is telling us, we then start to cherry pick in the sectors. Again, assuming that someone needs or wants to run an equity portfolio. It's not the be all and end all. There's plenty of other asset classes that we can use to achieve goals. But I think this is probably the most widely spoken to is the equity space.
Awesome. So let me run to the next question that I had, and forgive me for, I'm going to ask the silly questions on behalf of everyone, but if you were to say your top 3 sort of assets in 2023, what would they be? Are they the top 3 that are there, emerging markets, growth, and REITs, or what are you saying to us in terms of the assets to look at?
I'll jump in there. Looking at the asset classes, again, if you go back, you've got to be cognizant of the annualized returns that an asset class can produce. And then you've got to be very conscious of that volatility. Volatility equals risk. So you'll see that your risk on the far right-hand column, your volatility goes from the bottom to the top. So the REIT in the annualized return, real estate investment trusts produce the 3rd highest consistent average return, but they produce it at the highest volatility. Small caps, okay, have the 2nd highest volatility and the 2nd highest return. Emerging markets, 3rd highest volatility, and then you get down to that one where you've got asset allocation producing the 4th highest return annualized, but the 3rd lowest above cash and fixed income. So portfolio construction is about getting the highest return at the lowest risk. So this comes with a big risk warning when I say what we see, because this is very dependent on how long your outlook is. But all of these, and if you go back to the graph that we've just been on, move away from this one, you look at the volatility involved in an asset class. We believed at the beginning of the year, emerging markets, because of the very low base, they were very cheap, emerging markets would have a strong year. We still feel that emerging markets can have a strong year. We feel that developed markets might struggle a little bit. Okay, there's your developed market equities in the middle there in January, had a pretty strong January, but coming off a low base. So we feel on a 3 to 5 year, which is the equity cycle, that buying the small cap space now, for example, and selling the commodity space, which we would have done. Now, the commodities can still run, but if you look at, the commodities average return, we feel that commodities, whilst it can still run for a while, is starting to reach sell territory. All right. So in any portfolio, let me make the caveat that there's a geographical exposure to these asset classes. That's very important. We would still hold, because of the ability for the American machine to protect itself from recession, we would in a portfolio still hold between 50 and 60% of the portfolio in the USA. Okay, so that's where it's quite important to understand a real estate investment trust, but in what geographical sector. So what these heat maps tell you is what is cheap and what is expensive. And when we looked at 2022, if you had said, hold on, commodities are looking expensive, in 2023, they're probably not going to have the greatest year. Well, they had the worst January. And then emerging markets, the MSCI emerging markets, we would have said was a buy. And in our research, we would have said that in 2023, this is an asset class to own. Well, it proved itself in January. Now, what's important is we view that comments I made around the markets are likely on a cautiously optimistic outlook going to produce 10 to 12% return. Now we start looking at, hold on, but historically emerging markets, small caps are a little bit behind the curve. We believe those sectors can produce higher return than the average. So we would believe that small caps over a 3 to 5 year period bought now will have a better year and possibly do 15 to 20% because they were down, 30, 40%. And that's how you've got to construct a portfolio. But the percentages are critical. So we see value in emerging markets. We see value in oversold growth shares, tech shares, for example, which, had a very strong January, for example. So yeah, that's really what we're saying here, where we see the sectors is, more towards lightening on the commodities, more sort of towards emerging markets. But you're not going to go 90% into an emerging market in a portfolio. It's got massive volatility. But real estate investment trusts, for example, have had a very long, sustained negative period, but because of the income portion of it, it's going to go back. What is important about the other graph is you look at times of high interest rates, 2008, times of panic. I think fixed income and cash at the current interest rates will still hold a lot of the investment capital for the portions of this year. So like you can see there, 2008, you've got a big fixed income and a cash holding. And you see in 2009, you're starting to come out of that, the search for yields going into emerging market. So there are factors and plays around, the global financial crisis that will play out in any, bear market. And I think that's why we're still going to see, fixed income and cash holding a higher position in the markets this year because of how some of those things got damaged last year. So it's quite non-committal, and I'm letting people read into that with the, the caveat that the right percentages are critical. Okay.
Just a quick one, Garth. You mentioned sort of any portfolio would have 50 to 60% in America. And I know it's a broad brush, and I know it's, dependent on each person and all that sort of stuff. But if you were to take 100% and you got 50 to 60% in America, where else should you be looking if you were diversifying around the world?
So there, you're looking at portfolio principles again. So, I'm talking about the equity component at 50 to 60% in the USA. All right. Now I'm just taking the equity carve out. The remaining portions of that, you're going to look at the highly discounted. And this is where Anthony, as a portfolio analyst, will come in on the construction of these things. So let's say you've got 60 to 65% in the USA. We believe that machine can stave off inflation a lot better. We believe it's got a lot of the digital stocks. We believe it's got a lot of the, the stocks that are really big companies that can also, deliver. So that's why we go with that US equity carve out. But your emerging markets, right down to developed markets in percentages of 3%, emerging markets probably hovering closer to 5 to 7. If you drill into the emerging market carve out, that's also very important because you're not going to exactly be jumping up and down about Russia at the moment. So you're going to be looking at, your Asia ex-Japan, China, for example. We believe China has got long-term issues, long-term demographic problems in the population. But we're quite confident that China's got some way to go in terms of stabilizing its economy. It's forward-looking, GDP is hovering around 4.6 for 2024, 2023 marginally higher than that. So, you're looking at all of those carve-outs. So we would be quite light on the UK, on the Eurozone at the moment, a little light on the UK, probably increasing those after we get direction. And then Latin America, some allocations there are important to us. But that kind of gives you, the depth of diversification, the Australasia region, we would also favor in terms of infrastructure, some of the stuff that's coming out of there. Yeah. I mean, if that answers your question, Anthony, I don't know if you can answer that.
Yeah, I think it's hard. I think Eurozone is becoming a slowly but surely it's becoming a bit more attractive, and a thesis is definitely building up towards them. They've come out of a very tough 2022. The start of this year they were pretty much rock bottom. And when I say Eurozone, I exclude UK, as UK held up actually quite well last year. But yeah, they're looking at a bit of a turnaround there. They had a a winter that wasn't as extreme as they thought. So all of those kind of gas supply and those risks washed out fairly easily. So they were lucky there. That was very, very lucky. So a thesis could be made there. Like Garth said, China is starting to look very attractive at the moment. Again, that's not something where you just kind of throw all your eggs in one basket. That's an incredibly challenging region, and that needs to be managed by a professional. That is not just a kind of blanket ETF play where you kind of hope for the best. It's a very, very intricate market that needs to be understood by someone on the ground. But there is value there. Again, they're coming out of pretty much the worst environment they've been in. They've been in lockdown. They've had policies slapped onto every single asset class or every single sector of their market, which has really caused them a lot of pain, especially in the tech space. So they're looking attractive. Yeah, and then all the other kind of ancillary regions that Garth mentioned. But yeah,